Hello and welcome to the Smart Value Bites. I'm Soumitra Sengupta. Today we're going to talk about rebalancing and why frequent rebalancing adversely affects your returns. All portfolios need a rebalance protocol. There are advantages of rebalancing because it keeps your portfolio aligned with the markets and helps control risk and maintain asset allocation. It forms one of the cornerstones of managing a portfolio. However, very frequent rebalancing does adversely affect your returns. And the reasons for this are number one, transaction costs. Each time you buy or sell to rebalance your portfolio, you may incur brokerage commissions, the bid ask spread, and slippage. Slippage is the difference between the expected and the actual execution price. These costs can accumulate and reduce your net returns, especially if you're rebalancing very often, say, for example, daily or weekly. Number two, taxes. Selling appreciated assets to rebalance can trigger capital gains tax, particularly short-term gains, which are taxed at a higher rate than long-term gains. And over time, this tax drag significantly erodes your investment returns. Number three, lost compounding on winners. Frequent rebalancing forces you to sell outperforming assets to buy underperformers. This may interrupt the natural compounding of winners and reduce the portfolio's long-term growth potential. While it reduces risk, frequent rebalancing can also limit the upside. Number four, overcorrection from short-term noise. Markets are volatile in the short term. Frequent rebalancing may lead to reacting to noise rather than meaningful shifts in valuations or fundamentals, and result in buying low-quality assets just because they underperformed or selling quality assets too soon. Number five, opportunity cost. By constantly shifting allocations, you may miss out on momentum trends or other favorable developments in asset classes you trimmed back. Rebalancing too frequently can keep your participation in sustained rallies. So to summarize, rebalancing is important, but timing matters. Rebalancing helps control risk and maintain asset allocation, but too frequent rebalancing can cost more than it helps, especially in taxable accounts or high cost environments. So the recommended approach that we follow is to rebalance infrequently. In most cases, we rebalance 5 to 6 times in a year, and our yearly churn is between 30 to 45%. This allows us to stay with long-term trends while cutting out the laggards. The essence of momentum approach is to align the market to align with the market momentum and to generate returns for the client. And frequent rebalancing adversely affects this process and is harmful for returns.